Hello, and welcome to our first quarter strategy review for 2022. Once again, we wound up meeting via Zoom. With me were Len Skina, Vice President and CEO of the firm, Robert Toomey, Vice President, Director of Research, and Mark Carlson of Northern Trust Company. Mark turned out to be an excellent guest this time. He's a market strategist, and he talked about some of the things that are definitely on all of our minds. The Omicron problem, supply problems, higher interest rates potential, and all the things that we are concerned about. One thing, not stealing anybody else's thunder, but Mark was really involved in natural resources and gave us a very good rundown of natural resources. And his depth of knowledge was amazing, although we are not going to buy any fish, which is one of the things he talked about. But again, he also talked a lot about the bond markets and whether the bond markets are really suggesting that we are, in fact, in a high inflationary period. Again, let's move on. But again, Mark was an excellent guest, and we really appreciated having him with us. With that, I'd like to turn it over to Bob to talk about U.S. equities.
Thank you, Stan. It'll be my pleasure to talk about the outlook for U.S. equities. So as we look back on 2021, as most of you that might pay attention to the stock market would notice that volatility has been pretty high this year. And despite that, it has been an excellent year for stocks. Year to date, the US equity markets as measured by the S&P 500 are up about 26%, which is an exceptional year, much higher than the long-term averages. We do not expect another year like this in 2022. However, we do foresee a positive year next year. And there's a number of reasons for that I'll get into in a second. So I think, why has the market been so volatile in 2021? It's really, I think, the news surrounding COVID has been a key factor there. We've had, a lot of variability, week to week, month to month changes in the news on COVID and what that is the impact on the economy. And I think that has been the real important factor in causing a lot of this volatility that we've experienced this year in 2021. Other factors of late have really been, I think, the recent announcement by the Federal Reserve that they're going to accelerate the tightening regime, and also increasingly the news around inflation and concerns that inflation might remain high. So I think those three variables have been the biggest factors affecting this, volatility we've seen of late. With respect to inflation, I would say that we do foresee it as being transitory for a variety of reasons. We think that as we get into March and April timeframe of next year, you'll start to see year-over-year inflation rates coming down. With respect to Federal Reserve policy, I would point out that I think the Fed will remain deliberate. It will remain measured and data-driven. And even though we know that there will be some Fed funds rate hikes next year, I think the Fed has been very transparent in how they're going to do that and the data that they're looking at. So I don't think it's going to create a problem for stocks. So with respect to the outlook for 2022, we remain positive for a number of reasons. First, we don't see the economy going back into shutdown mode based on the Omicron virus. And in fact, President Biden said so much to that effect last week. We do see continued expansion for the economy and employment growth, and all of that is very good for corporate profits. And that's really the primary driver of stock prices, is growth in corporate earnings. We expect inflation to remain high for a while longer, but as I mentioned, as we get into the March and April timeframe, we expect those numbers start to come down, and we think that will be positive for the equity markets. We don't think the Fed will be drastic in the way it moves towards a tightening regime. And as I said earlier, we think the Fed will be very transparent and will do everything it can to not destabilize the equity markets. I would also point out that historically, if you look at Fed rate hike cycles, excuse me, the stocks have done well in the early phases of those cycles. And really, as long as the Fed is raising rates for the right reason, meaning because the economy is strengthening, stocks can hold up well in that kind of a rate rising cycle. I would also add that because of low bond yields, we expect bond yields to continue to remain low. That is going to be another reason that supports money flows into equities as investors seek higher returns. So with that backdrop, I want to turn it over to Len now to talk a little bit about the international outlook.
Thank you, Bob. On the international front, we continue to favor the developed economies, and we are 100% in large developed economies rather than in the emerging markets at this point. There are some policy issues in China that are giving us some pause with respect to what exactly is going to be their growth rate and what's going on there. And we don't really feel that the emerging markets are necessarily a place that we want to be with respect to the potential risk involved there for the current quarter. As we look at this, though, we did choose to add a position in a developed economy international dividend growth fund. And its ticker symbol is IDHG. It's an interesting fund in that the stocks are selected on a number of quality factors, including their free cash flow, including their the stability of their revenue and the consistency of their dividends. And it's a holding that we believe will help add a little bit of additional income into the portfolio while at the same time continuing to give us the strong returns, because we do feel, quite frankly, that the international area is poised to be as solid as any other area right now. They have more room to run. They are much less likely to be raising their interest rates in the near term. And so from that standpoint, we continue to favor the international front. We are at our maximum allocation right now to international stocks. With that, I'd like to turn it over to Stan to talk about REITs.
Thanks, Len. Once again, the REIT portfolio has continued to add a lot of value to our overall investment breakdown. And another thing that, of course, the REIT portfolio gives, which is very important, is gives a higher return, a higher dividend return, because remember, REITs pass through all of their income in order to qualify. So getting more income in the REIT portfolio is another reason why we're maintaining a very high level in the REIT area. We also are continuing to emphasize that growth potential for large apartment houses. So while we have a major holding in REITs generally, which of course cover all forms of real estate, large shopping centers, office buildings, and apartment buildings, we are continuing to emphasize the portion that is in the large apartments. Large apartments continue to benefit from a shortage. They continue to benefit from some of the controls that were put in, and the landlords are finally getting, it appears, back in control of their own property rather than the legal entities, which hadn't been happening for a while. With that, I'd like to turn it back over to Lynn again for fixed income.
Thank you, Stan. On the fixed income side, the Fed has definitely indicated that they want to accelerate their tapering. The Fed is trying to balance a number of things right now, and they are trying to keep inflation in check while also making sure that they don't do anything to kill potential growth in the US economy. And it's a little bit of a balancing act. At this point, what they're looking to do is probably not raise interest rates until perhaps the second half of the year. But they are going to accelerate the tapering of their purchase of securities so that will hopefully help drive interest rates up a little bit and give them a little bit of room to maneuver. With that, there are a few things that we have done in our bond portfolio that's actually reasonably consistent with what we've always done, but with a little bit of a tweak. The big tweak here is that in long-term bonds, we are representing it exclusively with treasuries now. On the intermediate side and on the short-term side, we are continuing to use either senior loans or high yield as a supplement to the treasuries that we have. But the bulk of the portfolio continues to be maintained in treasuries as well. We are anticipating that the overall bond market at this point will be such that treasuries will provide stability and will hopefully, keep things from getting overly volatile with respect to the overall markets. With that, I'd like to turn it over to Bob to talk about the rest of our holdings.
Thanks, Len. So you're all aware, if you follow your accounts and follow what we do, quarter to quarter. Within your accounts, we hold 9 core positions in each of the major asset classes. But we try to supplement those positions, as Len just mentioned, with other ETFs or that give us exposure in areas that we think are going to enhance returns or add income. And we think this is a very part of the tactical asset management that we do for you. And we really work hard to try to find securities and ETFs that will accomplish that goal. So I just want to reiterate, within the large cap stock area, we still continue to own a VanEck ETF called MOAT. M-O-A-T is the ticker. It's the wide moat exchange traded fund, and it's basically based upon the thesis that it will hold companies that have very strong competitive positions and very strong financial profiles, but also carry a buy rating by the Morningstar analysts. And this, we are holding this because we believe it gives us a good exposure to the value area of the market. Because I truly think I really think that value, what value really is in investing involves, I think, thorough analysis of finding intrinsically undervalued stocks. And what's nice about MOAT is that at least you have some human element of an analyst, a competent analyst looking for undervalued securities. So it's done great as a value investment over the long term. We still like that. In the small cap area, we are still holding the XME, the metals and mining ETF. We like that because we were a believer in sort of the reopening thesis. We think, as Stan mentioned earlier, inflation will run somewhat higher than it has over the past few years. And we think the metals and the mining area is a great way to, hedge inflation. It captures some of those price increases, hedging inflation, but also offers a considerable value because this sector has underperformed for a number of years. And we think there's still another year or two of outperformance for that area. Len did talk about some of our holdings in fixed income, the senior loan ETF, and also the short-term high yield corporate bonds. Again, those are two holdings that have significantly higher yields than the treasuries, but they give us an enhanced position, enhanced income in those areas, I think, to really supplement our core holdings in treasuries and fixed income. And we think as of now, given the outlook for the economy, those holdings look very strong. Finally, I'll just mention in the commodities area, we've increased our concentration in the Flex Shares Upstream Natural Resources ETF. The ticker symbol on that is GUNR. Again, we feel that it's done extremely well over the last year, and we think it's a very strong holding with respect to capturing what we think may be higher inflation and hedging your portfolios. And it does have broad-based exposure to energy, timber, metals, and agriculture. And so with that, I will turn it back to Stan for some final comments.
Thanks, Bob. And thank you all for tuning in this quarter. The quarter was interesting because we did look at a lot of things, but we still came down positive on the stock market. We also came down looking for more income, as you could hear. And we are trying to establish that in a number of different areas. We also, I heard a review that said that Omicron might peak in January. So hopefully when we get together next quarter, we won't have to deal with another variant, and we'll be able to look towards a positive, healthy future. Looking at this quarter, though, we did, as we always do, we picked a triggering event. Triggering event is something that we do not expect to happen. And therefore, it's only happened a couple of times in the history of our doing these tapes. This quarter, we again looked at consumer confidence. Our feeling being that as long as consumer confidence stayed positive, that we would once again be able to go forward without making any changes to our portfolios. So we will keep an eye on that. Again, it's something we don't expect to happen. And with that, I'd like to say thank you very much for tuning in, and we'll look forward to talking to you again next quarter.